Okay, welcome to Grand Slam. This is an anatomy of a 261.66% stock option campaign yielding $116,416.74 in just 111 days. And this is a true story with actual proof. I will never pay a dime of taxes on any of it because this brokerage verified trading tail unfolds within 3 Roth retirement accounts. Who am I? Am I qualified to guide you? I am Dr. Scott Brown. I hold a PhD in finance from the University of South Carolina. It cost the Darla Moore School of Business over $500,000 to train me. Only 2 doctoral students are accepted into that program every 2 years out of hundreds of serious applicants. No confusion as to why. Newly minted doctorates in finance command the same salaries as medical doctors, starting at $350,000 per year on Wall Street. The PhD who graduated the year before my cohort earns over $1 million a year as head of research for State Street. He combs the top finance research journals, discovering new ways to make money for State Street shareholders. He lives in a mansion in the Hamptons and collects sport cars such as the Maserati pictured later. Vladimir went to Wall Street, but I elected to enter academia with my PhD. I'm a professor of finance at the Graduate School of Business of the University of Puerto Rico on the main campus in Rio Piedras. I publish in top journals in the field as an academic. My research on investing has been featured by the Certified Financial Analyst CFA Institute. I comb top journals just as Vladimir, but I use my insights to enrich my family. Because I make $65,000 per year as a finance professor, I guess you could say my job has literally grown into managing our retirement portfolios. I had the opportunity to interview one of the 3 most renowned value investors in the world, Monish Pabrai. The other 2 most famous value investors in the world are Warren Buffett and Charlie Munger. That's Monish right there in the middle. You can listen to the podcast through links from any of my courses. The podcast is Master Your Money, and it's free on iTunes if you want to search it out right now. The week after I interviewed Monish, I had lunch with a good friend of mine who is a local CFA. My friend innocently asked me, why is Monish in Fiat Chrysler? All hedge funds must disclose positions to the SEC. My friend is a CFA, so he pulled the composition through Edgar, and I looked at him and I said, I don't know. When I returned to my home office, though, I pulled up this chart of Fiat Chrysler and my eyes popped out of my head. I was very startled to see such an excellent example of price impact. The stock was rising on high volume. The company was posting strong earnings. I knew that Monish was still holding the stock from lower levels in 2012. The monthly chart showed me that he had ridden through a 2-year downtrend, but was still ahead on his 2012 purchases. And equally important, I knew he was still dug in like a tick from my lunch with my CFA friend. This was a strong example of positive price impact, but it's vital to always remember to reduce risk no matter how great the opportunity appears. I made a test purchase of 54 calls expiring in March with a 7 strike on November 8th. I purchased each call for 90 cents. The test cost was $4,832.16. The stock held. I scaled in 2 other retirement accounts. We've got a lot of retirement accounts. More purchases 2 days later for $28,972.50 of 265, and for $10,687.34 of 100 more contracts in the same call. The option was deeper in the money. I paid over 30 cents more for these calls than I did on the test. The test in 2 scales completed my 2016 campaign on the rise of Fiat Chrysler Automotive, symbol FCAU. The stock rose all the way through February. I like to roll my deep in the money call positions every 6 months. It was time to get off the pot. I sold 265 calls on February 24th at $3.71. This generated $69,939.86 profit and a 237.94% return. 6 days later, I sold off 100 more calls for a profit of $30,224.33 and a yield of 282.8%. Then I sold off the 54 contracts for $4.10 and a profit of $17,255.55. This is the highest trade return in my career. It is 357.1%. The total campaign return is 261 0.66%. The total profit is $116,416.74. This is a screenshot of my retirement account statement documenting the initial test. Here's the exit documentation. Here's one of the scale's entry facts. Here's the proof of exit of the first scale. Here's the purchase of the second scale of 100 contracts. This is the exit documentation. The irony is that I actually made more money on Facebook, symbol FB, calls over the same period, but I was rolling up and out from a large prior position. The return was in the high 90s, but that ain't near as sexy as 357.1% return. Nonetheless, I earned over $250,000 from the stock market between November of 2016 and March of 2017. With the profit on the FCAU calls with this one stock option campaign alone, I could buy a quadruport for my wife like Comrade Vladimir did for his in the Hamptons. You have to remember that Fiat Chrysler also owns one of my very favorite brands called Maserati. Here's a novel idea. I change my socks and underwear daily. Why not cars? With the cash I grabbed from this stock option campaign, I could buy a Fiat 500 for each of the 5 working days of the week, plus one for the weekend. Each would be painted a happy color except for one. The brown car would be for bad market days. Or I could just buy the quadruport. Choices. Do you feel lost in the stock and stock option market? Have you been searching for the right mentor to guide you? If you want to spend a year learning from me in a closed community, the Elite Complete Option Package is for you. You get a series of courses designed to develop you from the foundations of simply saving to managing stock option campaigns on fast rising stocks like Facebook and Fiat Chrysler. This includes a year subscription to weekly market calls, my go-to webinar directly with me. You also get a 15-minute free call with me as onboarding into my community. I actually do want to know who you are. Your weekly direct interaction with me by group webinar is guaranteed, barring internet problems or sick days. And I will tell you my actual positions. I will show you the stocks I am watching. Daniel Hall says, following Doc Brown's teaching, I've grown wealthy in the market. Master stock options under the tutelage of a renowned trader and academic thought leader in investments. Develop into a thoughtful, independent steward of your family finances. Get this $4,997 training for 90% off at $497 right now, today. Enroll now at tradementors.com/options.htm. Let me repeat that for you. tradementors.com/options.htm. I've instructed Land to tear down this offer after 24 hours. Let me repeat that for you. It is his website, and I don't know what he will do. So if you are interested, enroll now. This concludes the presentation. I will answer any questions, then I will drop the mic. Okay, guys, that's what I got for you. Do you have any questions? How much can I start with? Is this Molabane Demby? How much can you start? Is that a question for me? Let me see what that's 1254. We're at 102. So yeah, it's probably a question for me. How much can you start with? Well, I started with a pretty small amount of money. Number one, you have to understand that all of the option trades that I do are deep in the money options. We've got a number of different studies out there. And in fact, if you just look at the payoff structures of any option strategy out there, you will conclude without looking at the empirics that the deep in the money call has the highest possible expected return of any option strategy out there. Now, some people will say, well, what about the deep in the money put? Well, the problem there is that a stock that's $100 can only drop to zero, but it can go to $200, $300, right? So it can triple, but it can only lose 100%. So the profits on puts are always limited compared to the profits on calls, and that turns out to show up in the actual data. So you want to make sure that if you're going after the kinds of numbers that I just showed you, and let me switch here to some charts so that we can look at some nice screen charts on my favorite platform that I use that helps me organize my stuff. Here we go. Don't forget, the package is over at tradementors.com/options.htm. And don't forget, there's also a free membership for Trade Mentors. It's a community over there. And I do send out weekly stock updates, and you can get those for free. So no matter what, everybody on this call right now should go over to tradementors.com/options.htm. Okay, so like if you take a look at this option here, then you'll notice that, or the stock Facebook, I'm really not going to get an option on this stock that's 6 months out in time for anything less than about $12. So since we multiply each contract by 100, it's about $1,200. Now the reality is, and I think Mohablani is how to pronounce your name. And I'm answering your question, how much do I need to start with? So, I mean, I literally started, I think, with about $2,000, probably about 5 years ago. Took me a long time of doing research to figure out that the deep in the money call was the highest potential profiting strategy of anything out there, whether it's selling puts or covered calls or whatever. There's nothing that can even hold a candle to the deep in the money call strategy. And the main trick is making sure that you can spot the stocks that are rising. If you can't spot the stocks that are rising, the strategy won't work. And that's what I do for an entire year. So I focus on you learning how to find stocks that are rising and how to filter those out. Because at least half of the stocks that you do test purchases on will fail. This one didn't. I was not surprised that this test didn't fail because the chart pattern was so powerful and pristine and strong. Scott Gao, what kind of data do you look for? 8590, is that what you mean by, delta? Yeah. So my delta, my sweet spot for delta, Scott, which was what I was going into with Mohabani, was that my sweet spot is 70 to 80. If I go over 80, it seems like you want to be really careful, and you want to take a really close look at the option chain. Let's go ahead and just pull up an option chain here. And I'll kind of show you what Scott's getting at. Let's go to Yahoo Finance. And I'll focus on the Yahoo option chain because Fiat Chrysler's kind of pulled back, had a nice strong recovery today. And I rolled most of the position, most of the profit out of Fiat Chrysler into Facebook anyway. So I do have a position in this, but it's not nearly the size. I think I've got $65,000 in it. And like I said, I pulled $250,000 out of the market. So it's not a particularly large position, but it's pulling back and I don't know what direction it's going in. So it's not something that I would even test. I just happen to be in it and I'm riding it. And of course, that nice recovery today means that I'm definitely going to be holding it as long as it will continue to move upward and hopefully break that face. See what's going on here is we've got two really clean faces in technical analysis that are downward diagonal pointing, and like Andrew's pitchfork would be a perfect tool to put on this thing. And of course, this platform that I use is my favorite because I can use things like the Andrew's pitchfork if I need it. But this is such a clean pattern, we really don't need it. But if I'm looking for it to break up above that trend line, and then I'm looking for it to break up above this trend line. That's what I'll be watching on Fiat Chrysler for the next couple of weeks. And of course, every week on Monday when I do my call, I go over these charts because that's my job. I manage it's funny, I've got a friend of mine who's a real wealthy guy, and he says, Scott, you're not a finance professor. Your job is you manage your retirement all day long. And it's true. I sit here and I manage our retirement. And so Facebook is, hitting a real critical price point. It's almost into new highs. So this is the one that I would be looking at really hard if I was going to do a test purchase for calls. And so which option would I choose? I'm a spaz. I'm a vocal spaz today. FB. So I go over to Yahoo. My favorite place to go find. What I try to do is, there's a number of us that are professors, who believe that the internet has become so efficient at data that you can get a lot of free data that used to be really expensive, and things like option chains are an example. Now, when you lay the trade on, if you're in TD Ameritrade or Options Express or something, then you're going to pull up the actual chain before you lay on the trade. But April is way too close. Now, again, you know, I'm always looking about 6 months out. And September, see, if we go from September, we jump to December. So September is the sweet spot where you would be making a test purchase if you were seriously looking at it. And again, what I'm doing is answering Scott Gow's question, which is what kind of delta. And so I can come over here and I can tell you that we're at 140. I'm in the 125. So see, these options are already pricing out at 20 bucks. So that's $2,000 per option. Now the delta on this thing's probably going to be up over 80, like 0.86. And if I want, let me see if I can get the Greeks. I don't want to log into my account, but if I log into my account, then I can pull up the Greeks. And I wasn't planning on actually pulling up any Greeks, but you're gonna probably be hitting a delta of 0.7 somewhere around the 130 mark, Scott. So I mean, you'd be buying these calls somewhere around, for sure, 13. Okay, you're going to be at 50% delta here. So the 135s are probably maybe 0.65 or so. So your lowest possible cost for entry would be $1,300 per option. If you were going to go for some deeper depth, which gives you more safety, then you're looking at, you know, $2,000 per option. Jan Larson says, can you explain a little about how you find my best stocks? Yeah, absolutely. What I do is I scan the market. Actually, every quarter, I go through about 2,995 charts. And what that does, it's not that I'm actually necessarily trying to find. I found Facebook on that particular scan. Facebook Fiat Chrysler was a different way I found that one. But like I said, if you're on my Monday call, you know what I'm looking at, because I was talking about Facebook Chrysler. Actually, the day I made the week that I made the entry into Fiat Chrysler and all the scales, I was telling everybody what I'd done. So I tell everybody on my Monday call what I'm doing. And I keep a really compact portfolio. I don't have more than 4 stocks in my portfolio, so I keep it really concentrated. And then I want those deltas somewhere between, like I said, 70 and 80. If you go over 80, like if you look, for instance, back at this option chain again here, as you go deeper and deeper, like when you get down to like 85 and 80, if you pull up the calculator for delta, you'll see that these are hitting 1. Once you hit 1, Scott, you're just throwing your money away. It doesn't make any sense to buy an option with a delta of 1 because it's so much more costly than with a delta of 80, and it's not really giving you much more protection. Does that answer your question? So you're saying 85, 90, I'm saying 70, 80, I feel like is my sweet spot. And at the beginning, if I'm making a test purchase, then, and Renee, you can step in and stop me because I have no idea what time it is and what time I got to get out of here. But if you make that first test purchase, there's some times where I'll actually make a test purchase of about with a delta of about 50, and the reason is because if I get it wrong, like I said, I can have a failure rate of up to 50%, and I try not to test more than 6 or 7 stocks throughout the whole year. So I'm a very, very extremely infrequent trader, and then I've been trading Facebook, oh my God, for a couple of years now and making money on it. So Scott Gow says, sounds similar to how Chuck Hughes buys options. I'm just learning. Okay, no problem. I don't know who Chuck Hughes is, but if he's buying deep in the money options on stocks that are rising, deep in the money calls on stocks that are rising, then he is employing a system that is indeed similar to mine. There's no doubt. Any other questions, you guys? Was the presentation boring? I kind of like the idea of owning a Fiat 500 for every day of the week. Is it time for me to leave? Okay,
Scott,
so we've
you
got,
still have quite a bit of time. Your original presentation was for 45 minutes, so you still have about an hour since you started
oh,
early.
we're getting, that's great. We've got questions coming in. I'll sit here the whole time and answer
Yeah.
questions. So Yakov Trader says, why not buy options slightly out of the money? Okay, so if you think about options being slightly out of the money and compared to options that are deep in the money, what you want to think of is margin of safety. We've got this old concept way back in the 30s and 40s. It was called Roy's margin of safety. And Professor Friedman and Savage came up with this whole concept, and it's kind of some crazy stuff, but that can create justification for these highly levered concentrated portfolios. And if you take a look at the option chain, and as you go down this call option chain here, as we go further out of the money, the more speculative the call gets, the riskier it gets. As we go further into the money, the less speculative it gets. And the reason is when you look at, this is at the money right here. So when you look at the Black-Scholes option pricing model, the best way to understand it is if you took a, let me find a bell curve out there. So we got a bell curve here. So if we take this bell curve, and let's say that we ask the question, you know, what's the stock price going to be a week from now, or a day from now, or a month from now, or a year from now, then there's a bell curve of possibilities, right? So there could be, the stock market could rise, and that would give us positive returns. The stock market could fall, that would give us negative returns, and we don't know for sure, right? So when we're looking at the option chain, and when we're out of the money, in this case on a call below the level at which the stock is, or more or less at the level at which the stock is actually trading. Facebook right now is trading at, let me see what it's trading at. Facebook is trading at 142.40. So right here, 145, 140 is at the money. So if you take that bell curve and you tilt it, you could think of all of these different prices as being possibilities for the actual stock to pay off. So in other words, it's a lot less likely that the market will actually close above $190 than it will close above $140. And so for that reason, the at the money calls are a lot more expensive than the far out of the money calls. But for the same reasoning, an option like the ones that I'm holding right now, the 125 strike Facebook calls, these things are a lot more likely to close in the money than the 140 calls, right? So just logically, you need to understand that the deeper in the money we go, the less speculative, the less risky the call actually is. The farther out of the money, the more risky it gets. So I do not recommend out of the money calls under any conditions. The closest I'll ever get to an out of the money call is if I'm actually you know, putting on a test and a new stock, the pattern looks good, but you never know with any stock. I mean, you could get a market crash that could pull down the best stock in the world, and you could still have the best looking pattern on a stock. And because the general indexes drop, it gets pulled down, which is why every week I'm taking a really hard look at the VIX. I'm taking a hard look at the Dow Jones Industrial Average. I'm taking a really hard look at the S&P 500, right? So, that's the answer to that. And the answer is no, don't go out of the money. Don't go out of the money. Okay. Scott Gow says, interesting. Thanks. Jan Larson says it was great. Thanks, Jan. Timothy Peterson says, not boring from an academic. That's good to hear. So how do I scan for trending stocks? Timothy Peterson asks. I have a software tool, and since you've asked the question, I have to answer it. And if you will go over to tradementors.com/tools, you'll be able to download it. And it's called ChartMiner. Now, the thing is that I've spent a lot of time, I've been very blessed in the fact that I've been allowed to complete a PhD in finance that's so restricted and allowed me to be trained by such incredibly gifted intellects. And so we've spent a lot of time thinking about how the mind interacts with finance. And so, for instance, what I've noticed is that a lot of people approach finance because they're very mathematical and very much caught up in their frontal lobe, right? So they're very much, when they think through a stock, they'll think through a stock as having certain earnings characteristics, certain beta numbers, but it's basically numbers that's coming to their minds. There's a much more powerful part of the mind that has allowed us to survive over the millennia, and that is our visual cortex, which we use for both hunting and gathering. And it's what the part of the mind is that works, that identifies things that are good or bad, perceived as good or bad in our environment, and then reacted to for fight or flee, or gather to eat or grow or whatever. And so what's going on with my tool here? It's loading. And so what I do is I had this tool created, and we'll let it load. And what it is, it's a Rolodex of charts. And let me pull up. So this is the website for my option training. It gives you a year of access to me and tutelage under me. But if you want to train your visual cortex, because you asked the question and I got to answer it, I will not deceive you. Trade mentors. We weren't planning on promoting this tool, but here's how I find them. I use my visual cortex. I don't use my frontal lobe. And I do it with ChartMiner right there. So you go to TradeMentors.com tools and pick up ChartMiner and what I'm about to teach you. If it'll load, what the heck is going on? It's the first time that it's taken so long to load. Or maybe I just do other things and let it load. I'm not normally pulling it up to do a presentation. See, we're on C. I'm going to close it and try and load it again. And so basically, we used to have these old tools. They used to send these, back in the old days, the old traders used to receive these chart books. And when the chart books would come in, these printed chart books, they would scan through these charts. And so they would look for these patterns. And we'll go through and I'll show you what kind of patterns we're looking for. So for instance, when we look at Facebook, well, here, my wife has a lot of Banco Popular stock. No, that's not showing what I'm looking for. But you can see that when Facebook started falling back here, we got a large jolt of I actually rode through that, and we got a large jolt of volume that came in, and then the market stopped dropping. These are the kinds of scenarios that you're looking for. They don't show up that much in the data. I don't know why this tool is taking so long to load. That's the first time it's done it. And of course, on a call where I'm showing it to you. It's like Murphy's Law. It's just hilarious. So anyway, I go through that chart scanner and I'm looking for patterns of companies that are rising on good volume. Toll Brothers is one that's, for instance, showing some good volume patterns. Starbucks is one that's showing some good patterns. But I picked up, if you'll notice on the screenshots that I picked up, test purchase in Starbucks and kind of did a little bit of scaling into it. And then I ended up riding through all the sloppiness and I finally just tapped out. I think back over here and then went and picked up some Fiat Chrysler or Facebook or something with it. But this is one that you can see you've got this nice punch in volume coming in. You got two punches here. And then you've got this punch over here of volume. I am baffled. I can't figure out why this is not working. All right, eventually we'll probably do some sort of promotion for this. You can download it, and it does work. And what it does is it creates 2,995 charts, and I just sit there and click through them. It takes me, if I need to do a really fast scan, like back in November, November was really crazy because we had when was the election? We had whatever her name was, because she's a loser according to Trump. Anyway, that was wicked that night because studies show that a sitting Democrat president is better for the stock market. So, the market was rising really strongly as it looked like Hillary was going to win. And then when Trump started to win, the market just went straight down. So, I mean, that was a real stressful night. And then when it came back, the market started rising again. And if we go back here and if we look at the spider, back in November, that was this thing right here. See, this was that whole Trump Hillary election period. And so when this volume came in, I knew the market was coming back. And so I had to do a scan, and I forget what day it was, but I had to go find stocks and make sure that the stock market was actually rising. And so when I need to know if the market's actually rising, then I'll do a full scan across 2,995 charts using this particular tool here. It looks like it's loading them. It's up to H. Maybe it will load them all. I guess we've still got a half an hour or so to go, or 45 minutes to go. So once it loads, I'll actually go through the process and show you what I do, since you got me on the call right now. Scott says, would you focus on stocks in the NASDAQ 100, or what index would you pick from? Well, the way that, I actually had this tool programmed for me. Lan has these programmers over at Gecko Software. And I said, Lan, I need those old chart books. Remember they used to mail them out? I need you to create those in a Rolodex. So his programmers went and programmed this thing. Then they came back and they had all these old technical analysis bells and whistles. I said, have them strip all that off. He's like, what? I said, have them strip it off. And then when I stripped it off, he says, oh, I see what you're doing. I'm like, yeah, I only want to see price and volume, which I'll show you. And you're training your mind to only cue on price and volume. You want to strip the chart back from every single thing but price and volume, Scott. And the reason for that is because you've only got two pieces of data that are coming at you off of a chart. That's price and that's volume. And so if you're looking at something like a MACD indicator, or if you're looking at an Andrews pitchfork indicator, you always have to remember that you're looking at a transform of the exact same data, So for instance, these price relationships here, like for instance, the price relationship between the 125 call and the 115 call are measured by delta, but delta is still nonetheless a transform of the core underlying granular data. Does that make sense, Scott? You always have to remember, what is my granular data? Does that make sense? And when you're doing your search for your stocks, you have to use and focus on granular data, because the unconscious mind can figure it out. Your visual cortex can figure out what's going on just with a 1 second glance at a price chart. That's how powerful. Okay, there's something wrong with this program. Gosh darn it. What a bummer. That's really a drag. I mean, of all the times for this program not to work. So so that's how I go and I search those out. Does that make sense? Any more questions? You got me. Ask away. Scott says Facebook seems like a great pick. Yeah, I mean, the irony is, let's take a look at Facebook. I'm shutting that program down. It looks like it's not working. If we look at Facebook and we go back on the monthly data, what a lot of people didn't understand was that, let's back it all the way up. That's why I love this. That's why I love Gecko Software products, because they allow me to do my stuff. Okay, great. So I'm gonna, because I can go back in time with my Gecko Software platform. I can't do that with any other platform. So we're going back in time. We're going all the way back to 2013, the year to 2012. We'll go back to 2012. This is Back to the Future Day. for you. Okay, so, okay, great. So Facebook came out, and it was a really unique IPO because it IPO'd across the NASDAQ, which a big company like that had never done that. Normally, when you get a really big high cap company like Facebook, they will IPO out across the New York Stock Exchange because they don't want to deal with the little chumps over on the NASDAQ. And so they rolled out on the NASDAQ, and there's a study by Jay Ritter at the University of Florida. He's a top guy, and he shows that people should not buy IPOs because they have a tendency to fall like this after they come out. And so this is what I saw, and I was like, okay, I'm ignoring that stock. And then what happened was that, let's kind of roll forward a little bit. And then what happened was that this is the daily chart, and now we're looking at February of 2013. This is quite a while ago. And what you notice with this chart is that you notice that there's a lot more volume on this half of the chart than there is on this half of the chart. And that's what I noticed. And this is a classic key sign of price impact. So basically what it said was that the stock, had come out of an IPO, and then it weakened and it collapsed. And so the market ignored it over here. And then suddenly somebody was buying it up. You don't know who it is, Scott. I mean, it may be, I'm talking to Scott Gow. And you don't know who it is, but when you get these big punches on a big high cap stock like that, it has to be some institutional. And so this tells you that some institutionals buying it. The institutionals have to report within 24 hours, but it can still be a few days before it comes out on the, the F13, I think it is. And even then, who in the heck is paying attention to all the F13s to know who the heck actually bought into this thing? So it turns out that price impact, which is the interrelationship between the trend on the price and the volume punching into the market, is an extremely powerful forward predictor, according to Professor Yaakov Amahud at New York University, which has been seriously confirmed just in the last 10 years. This is something really new that I'm teaching you. What I'm teaching you is really cutting edge. And you may say, oh, but this has been around before. Yeah, it has been around before, but academics had not verified how profitable this is. So there's a lot of different things that have been around before, but you don't know which one is actually profitable, and this one is. And so you want to be, by paying attention and looking through a lot of charts. By the way, on these charts, I do run a 10-day moving average, but I don't on the ChartMiner charts, because when I'm over there, I'm doing a scan. And, like any of you guys that have joined the options training, on any of the Monday calls, every 3 weeks I do the scan right in front of you. So you should be doing it yourself, because if I do it, you don't learn. But I have to do the scan every 3 months. So I take, I usually take 2 or 3 weeks every 3 months, and I do the scan during the weekly call. It's really cool. It's really productive, and it gets a good discussion going. But so that was the scenario that I saw, and this was right about when I did my first purchase, about in 2013 in Facebook. And then of course, what happened was it rose and rose and rose. Now every time, or it didn't, see, like in this case, it fell a little bit. Now you can see if I've tested this stock and it starts to fall like this, I have to get out, or I have to hang on and ride through a big loss. So it takes an awful lot of concentration and common sense, and then sometimes just plain courage to ride through these swings. So now we can see the market starting to turn back up gradually. But you can see how scary this move is. That's what I love about this platform. You can actually go back and feel emotionally what you were feeling. Remember, I don't know that I actually bought at this point. I'd have to go back and look. I don't think I did, obviously, because it was downtrending. I bought and then it was rising. But I got caught in a few of these downturns. So when you're trading deep in the money calls, don't think that everything all the time is going to be, rosy colored. It takes a lot of work to get, there we go. Now we're turning back up. It takes a lot of work. There we go. Okay, that was where I did it right there. Bingo. What I saw was that I showed you before, we were seeing the volume kind of build up. And then we got this massive slug in volume here. This is when I bought. And we got this gap that moved up. And you can see where I'm at. See, I'm back up at about the price that it was right at the IPO price. And then from there, it's just been maintaining the position, rolling it forward. And I think I got out of it once and moved over to Apple, and then Apple pulled back. But you can see I bought this thing and actually pulled back before it started rising. And when it has these nice strong runs, you know, because the call options are so highly levered, even the deep in the money calls, those are days where I was making 15. I was sending Lan Turner screenshots of $15,000 days, $30,000 days, $20,000 days. Scott Gow asked, do you buy puts also? My answer is no. And Jan asks, hold on, Scott. Jan asks, do you do your visual scan with a daily, monthly, or weekly? I do use daily and then monthly or weekly, depending on which gives me the better long-term view. If I've got a stock that's only recently been out on an IPO, then I may not have enough data to have a good view on the monthly, so I have to kind of pull it back a little bit to the weekly. But I'm always alternating between a short-term view and a long-term view. Okay, so Scott Gow says, do you buy puts also? The answer is no. However, I do have two friends of mine who I do hold in regard as being very intelligent in the market who do make money with puts. So is it possible that I might be puts in the future? It could be. I mean, you know, if we get a big, I don't know. I don't know what the scenario would be under which I would buy puts, but I do know that there's profit potential in long puts. When you look at the studies, like for instance, in the option package, if you're in the more advanced option training, I take you through the study by Boyer and Vorkink in the Journal of Finance at the University of Utah. And they actually took all of these strategies and broke them down to their most basic components so you could put them together and see where the profitability was. And the highest returning strategy by a long shot was a deep in the money, was a long call. And then after that was the long put. So I know for a fact that there is profitability potential in puts. But, you know, when we look at, for instance, the S&P 500 right now, we're in a bullish phase. My answer is that at least intuitively, it seems like I'm more likely to make more money in calls during a bullish index phase. And then, of course, it might make some sense to attempt to make money with puts in a bearish index phase. So right now, at this point in time, that's the extent of my intuition on the long put strategy. However, I do constantly interview. I have a podcast and everything, and I interview some pretty heavy hitters. So I am trying to get a feel for what these guys are doing when they're actually trading, long puts on options on stocks, right? So the answer is no, but it is a potentially profitable strategy. It doesn't have nearly the expected return that the call does, but it does have potential profitability. And that long period right there, where Facebook is going sideways and you're holding calls on that stuff, can be some pretty painful stuff to sit through, since we're letting the Facebook movie unfold.